Understanding the wisdom of markets. Lessons from Keynes. Markets can remain irrational longer than you can remain solvent. This timeless quote from John Maynard Keynes has guided investment strategies for decades. It's a stark, yet empowering reminder that no matter how seasoned or prepared an investor may feel, the unpredictability of markets cannot be ignored. In this video, we'll break down the meaning of Keynes's wisdom and translate it into actionable strategies. By the end, you'll know how to protect your capital, sharpen your discipline, and let risk management guide your path to long-term success. Let's dive into the essence of risk management and what it truly means to thrive in an irrational market. Let's begin by asking a simple question: why do markets behave irrationally? Markets often defy logic and rational expectations. They swing wildly in unexpected directions, driven by emotional trading, herd mentality, speculative bubbles, or macroeconomic surprises. Investors, even seasoned ones, sometimes get caught up in these irrational movements, assuming that the markets will eventually correct themselves. For example, consider the speculative Dotcom bubble of the late 1990s. Investors rushed into tech stocks, convinced that these companies would revolutionize industries. However, many of these businesses lacked strong fundamentals and eventually collapsed, leading to massive losses for those holding their positions too long. This unpredictability is why relying solely on rational predictions, even when supported by data or analysis, can be a dangerous trap. Betting against this irrationality without proper safeguards can put even an experienced investor at financial risk. The lesson here is simple but crucial. The market does not owe anyone a correction. Hope is not a strategy. Let's talk about one of the most common mistakes investors make: assuming that markets are bound by logic. Picture this scenario. You're holding on to a losing position, convinced that the market will correct itself any day now. After all, the stock is undervalued and it's only reasonable for the price to recover, right? Here's the problem. While you're waiting for the rational correction, market trends take on a life of their own, pushed by forces beyond reason. And as the market remains irrational, your losses grow. Worse yet, overconfidence often leads to over-leveraging. Over-leveraging magnifies both gains and losses, placing tremendous pressure on your financial stability. In an extended period of irrationality, this can lead to devastating consequences, even for seasoned investors. The key takeaway is this: the market's behavior is beyond your control, but your response to it isn't. Here's where risk management steps into the picture. If there's one mental shift you take from this video, let it be this: successful investing is not about predicting the market. It's about protecting your capital. Far too often, investors focus on finding that perfect prediction model or mastering market timing. But the real pros, those who remain solvent and successful in the long run, know the truth. Survival in an irrational market depends on disciplined risk management. Think of it this way: the unpredictability of markets is a given, but by protecting your portfolio from major losses, you give yourself the resilience to stay in the game. And staying in the game is how you ultimately thrive. Remember, the market has no obligation to align with your expectations. Your priority isn't to outsmart it. It's to protect your wealth from its unpredictability. Let's dive into the 3 pillars of effective risk management: position sizing, stop-loss orders, and disciplined exits. These aren't just strategies. They're the lifelines that every seasoned investor relies on to navigate turbulent markets. The beauty of these tools is their simplicity. They aren't about trying to perfectly time the market. Instead, they act as guardrails to ensure that irrationality doesn't derail your long-term success. The first pillar is position sizing. Why does it matter so much? Because overcommitting capital to a single trade or asset can quickly lead to financial instability. Position sizing allows you to balance risk and reward while keeping your portfolio resilient. Here's a simple rule: never allocate more to one position than you're comfortable losing. Seasoned investors typically base position sizes on their overall portfolio value and risk tolerance. For example, you might decide to never risk more than 2% of your portfolio on any single trade. This principle protects you from catastrophic losses. If one position goes south, it won't devastate your entire portfolio. The goal isn't to avoid losses altogether, but to ensure that the inevitable bumps in the road don't throw you off course. Next, let's talk about stop-loss orders. Think of these as the safety net for your portfolio. A stop-loss order automatically sells your position if the price drops to a predetermined level. Why are stop-losses essential? Because they take the emotion out of trading. When markets move against you, it's easy to fall into the trap of just holding on in the hope of recovery. A stop-loss removes this emotional temptation, ensuring that potential losses are capped. Let's say you set a stop-loss at 8% below your purchase price. If the stock falls to that threshold, the position is sold automatically. You lock in a manageable loss and preserve your capital for future opportunities. Seasoned investors swear by stop-loss orders because they enforce discipline even in volatile and irrational markets. Our third pillar is disciplined exits. This is where many investors struggle, not because they lack the tools, but because they can't shake the emotional attachment to their trades. Disciplined exits mean having a predefined plan for when to sell, whether you're securing profits or cutting losses. The key is to stick to this plan, regardless of fear or greed. Imagine you set a goal to sell a stock once it hits a 20% gain, but when that target is reached, you hesitate thinking, let's see how much higher it can go. Sometimes this gamble pays off, but often it doesn't. Discipline means exiting when you've reached your target, no questions asked. It also means walking away when your stop loss is triggered, even if you believe the market might bounce back. Let's break down position sizing further. How do you determine the right size for your positions? It starts with this question: how much are you willing to lose on a single investment without jeopardizing your overall portfolio? For many seasoned traders, the answer is no more than 1 to 2% of their total portfolio value. Let's say your portfolio is worth $500,000. A 2% rule means you're willing to risk $10,000 on any single trade. But risk isn't just about dollar amounts. You also need to factor in the asset's volatility. Riskier investments might require smaller position sizes to manage unpredictability. By sticking to these rules, you avoid placing all your financial eggs in one basket. The greatest advantage of position sizing is that it limits the impact of any single error, protecting you from the market's variability. Stop losses are among the easiest tools to implement, yet many investors underutilize them. Why? Mostly because they let emotions, fear, greed, overconfidence, cloud their judgment. Not using stop losses can lead to devastating consequences. Imagine a stock drops 30%, 40%, or even 50%. Without a safety net in place, these kinds of losses are not just demoralizing, they're debilitating. When setting stop loss levels, aim for a balance between protecting your downside and giving yourself enough room to navigate short-term volatility. For instance, an 8-12% stop loss level is common for many stocks. Using stop loss orders doesn't just protect your capital. It also creates a disciplined framework, freeing you from the emotional burden of difficult decisions. Finally, let's discuss one of the hardest skills for investors to master: knowing when to let go. Discipline in exits is about sticking to rational decisions despite what your heart, or even your gut, tells you. Here's what often happens. An investor hits a preset profit target, but instead of selling, they hold on hoping for more. More often than not, the market turns, wiping out gains and sometimes leading to losses. The solution is simple. Decide your entry and exit points before you make any trade, and then follow through. Having this discipline cultivates confidence and consistency in your investment process. On the flip side, discipline also means walking away when stop losses are triggered. It's painful to admit defeat, but it's far better than watching a small loss snowball into a catastrophe. Professional traders and seasoned investors approach the market with a unique mindset. They know their success isn't about predicting where the market will go next, but about managing risks when they're wrong. These investors accept small losses as a normal part of trading. They understand that not every trade is a winner, and that's okay. What matters is keeping those small losses from turning into major setbacks. By adopting a disciplined, process-oriented approach, you can remove emotional decision-making and focus on what truly matters: long-term success. The goal is resilience, not perfection. To wrap up, let's revisit the wisdom of Keynes. Markets can remain irrational longer than you can remain solvent. This is not a cautionary tale, it's a call to action. Markets will behave irrationally, that's a given. But with solid risk management tools like position sizing, stop-loss orders, and disciplined exits, you can protect your wealth and stay in the game for the long run. The time to implement these principles is now. Don't wait for the next market cycle or the next trade to start managing your risks. Begin today by reviewing your current strategies and ensuring that safeguards are in place. Remember, the market doesn't owe you rationality. Your greatest strength as an investor lies in your ability to protect what you've built and keep moving forward, regardless of how unpredictable things get. Your financial success is waiting, and it starts with the choices you make today.